Mortgage rates up dramatically. Will home prices fall? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client. Or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005. And here is the market data that you need to make an informed buying or selling decision or help your client do the same. There is no better place to start than with the impact of rising mortgage rates on the housing market. A lot of people are seeing mortgage rates rising and they're asking, are home prices going to fall? What's going to happen to sales? There's a lot of questions out there and a lot of uncertainty. So let's go back and look at the historical data to show you what's happened when mortgage rates were rising and what happened in those environments so that you can use the data and the facts to create your own opinion on what's going to happen going forward. Here is a look at how mortgage rates have been rising this year. This is data from Freddie Mac and it goes back to the beginning of this year. What you can see over there on the left is that mortgage rates started at about 3.11% for the average 30-year fixed at the beginning of the year, and they have just steadily climbed since then, up to 4.67% through the end of March. And unfortunately, at the time of this recording, rates are even higher. So a lot of people are asking why? Why are rates rising? Here's a quote from Freddie Mac to answer that question. Mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increases is likely to moderate. Much of the increase in rates in early 2022 is an anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy. So, as we look at mortgage rates rising, we are projected to see them to continue to rise, but at a more moderate pace. Now, as I mentioned a moment ago, the big question people are asking is, what's going to happen to home prices as mortgage rates rise? A lot of people think that when rates go up, prices come down. Let's look at some data to determine how well that hypothesis holds up. So what you're looking at here is the impact of rising rates on home prices when mortgage rates rose by more than 1 percentage point. This goes all the way back to October of '93, so almost 30 years. And it shows you that there was an average of about 8% home price appreciation as mortgage rates rose by more than a percentage point. So based on this alone, rising rates have not had a negative impact on home prices. But let's take this a little step further because I think a lot of people have more questions about what's going to happen with sales. So let's add a column on the right here showing how home sales were affected for the same period of time going all the way back to 1993. What we can see here is there was an average of a 5% decrease in home sales as rates were rising. We know as rates rise, that tends to sometimes reduce buyer activity as it prices some people out of the market. So what does this mean overall? Well, first of all, it's important to note that we have a fundamentally very different housing market than what we had in some of these environments. Let's take a look at this first line, for example, October '93 to December '94. Mortgage rates increased by 2.38% to a final rate of 9.2. By the way, we are not looking at a 2.5% increase in mortgage rates right now. We're not projected to, and we're certainly not projected to, according to the experts, get up to 9.2%. So that was a very, very different environment than what we're in today. So it's appropriate to eliminate that period as an outlier so that we can focus on the rising mortgage rate environment that's closer to what we're seeing today, which is a 1 to 1.5% increase. So looking at the same data and accepting that the lead up to the housing crash in June '05 to July '06 was also an outlier, there is negligible impact to home sales. So despite higher rates, home prices rose and the number of home sales were negligibly impacted. But why? Why is that? I think one of the big factors that we have to look at is what is available for sale. We have to look at the inventory component because today what we're seeing is drastically low inventory. Home prices are projected to continue rising because there just aren't enough homes for sale. Supply and demand are what drives home price appreciation. Can rising rates affect demand? Sure they can. But it would take significantly higher rates to taper demand down to reach equilibrium with the trickle of supply that we have available today. Buyers cannot find a home to buy. There's not enough inventory to do that. So when you see headlines about softening in home sales, it's not because of rising mortgage rates. It's because there aren't enough homes to buy. So the inventory data really helps paint the picture of what's happened historically and where we're headed as well. Let's add another column to the right of the table showing months of inventory. We only have the data going back to 2003 and '04, which is when we had 5 months of inventory, 4.5 months in '05, '06, and 4.8 months in 2012 and 2013, which was a very, very different inventory level than what we have today of roughly only 2 months. So if prices didn't drop with those inventory levels, and if sales were only negligibly impacted, then what do you think is going to happen due to the current inventory levels? Well, of course, prices will continue to rise. Let's look at what the National Association of Realtors is saying. While higher short-term interest rates will push up mortgage rates, I expect some of this impact to be mitigated eventually through lower inflation. Thus, I expect the 30-year fixed mortgage rate to continue to rise, although we aren't likely to see big jumps that occurred over the past few weeks. So what is this saying? It's saying inflation is driving this increase in mortgage rates. We expect it to continue to rise, but it won't be at as quite a rapid pace as what we've seen over the past few weeks. Here is what Freddie Mac had to say. History suggests that when rates rise, there is an initial bump in home prices as many move quickly to buy a home before rates increase further. But after that period, home prices slow. Freddie Mac analysis shows that a 1% increase in mortgage rates results in home price appreciation that is 4 percentage points lower. For instance, a 1% increase in mortgage rates would change home price growth from 11% to 7%. So Freddie Mac is saying that home price appreciation will moderate. Mortgage rates will slow some of the frenzy, but we're not talking about depreciation. We're talking about a softening or deceleration. And that will help slow some of the frenzy as we move forward in this housing market. And then there is also this quote, which I think is the big takeaway, a really good one, also from Freddie Mac. With rates rising and expected to rise through 2023, it makes sense to obtain a purchase or a refinance mortgage if you are in good standing. So there's the data, there's the insights, the historical context. I hope that helps you as a client or as a realtor as you look back at what's happened in the past to be able to formulate your opinion based on data, based on facts about what's going to happen in the market. Share this message, pass it on, so that more people can formulate their own opinion of what's going to happen with home prices instead of falling prey to negative headlines. The National Association of Realtors just came out with the most recent buyer and seller traffic maps. Let's start with the buyer traffic map. All over the country, with very few exceptions, strong traffic from buyers. The rise in rates is not slowing down buyer traffic across the country. But if we look at the other side of the coin, seller traffic, you can see very, very weak seller traffic across the country. This is what keeps that upward pressure on prices. It goes without saying that more and more industry insiders are throwing out their previous forecasts and replacing them with more bullish short-term outlooks. Some experts say the 2022 spring housing market might go down as one of the most competitive on record. Here are some slides that if you're a realtor, you should have on your phone to show clients this spring. This slide does a great job of showing why we're in this inventory situation. This is single-family housing units completed, and this tells a story of why it's so hard to find a home right now and why prices have risen the way they've risen. And the simple answer is right there in the green. For 14 straight years, we've been below the 50-year average in new builds in this country, going all the way back to the 70s. Literally, back in the 70s and 80s, there were more homes completed in this country than there have been in the last 14 years. All of that coming out of fallout of the housing crisis in 2008, when builders were hit extremely hard, affecting their ability to bring new builds to market. The other issue I think is going to be a big concern for a lot of consumers this spring is inflation. This is home ownership as a hedge against inflation. And that's what we want to be able to show buyers. When you're in an inflationary economy, you want to be invested in hard assets that outperform inflation. And this is going back all the way to the 70s, the blue bar there being the inflation rate, the green bar being home price appreciation. As you can see, in most decades, home price appreciation has outperformed inflation. Many people are wondering, should I buy right now? Is this the top of the market? This graphic shows just what's at stake. The Home Price Expectation Survey is a survey of 100 economists, real estate professionals, market investor professionals that say what they think is going to happen with home prices between now and 2027. And this is the potential growth in household wealth over the next 5 years based solely on increased home equity if you purchase an average price home of about $360,000 in January of this year. And what do you stand to lose? Well, just over $96,000 in home equity. That's over 26%. This slide is also for those people waiting on the sidelines right now for home prices to go down. These are the 7 best experts here, and on average, home price appreciation being 6.7%, which you can see in the green bar. Not one of them is forecasting prices to go down. No doubt, this will be a competitive spring market and a competitive year. So that's a wrap for the April monthly market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks again for watching. Bye for now.